You weren't supposed to hear this, because when a man who built his empire teaching millions how money really works says he would choose Bitcoin over gold if forced into a corner, that's not just an investment opinion, that's a signal. And signals like this don't show up at random. They show up before something shifts. Robert Kiyosaki isn't just talking about assets, he's talking about power. He's talking about scarcity. He's talking about the silent war between real money and fake money. And if you don't understand what's happening beneath the surface right now, you're not just missing opportunity. You're volunteering to be on the wrong side of the transfer. If you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. Because this isn't about whether Bitcoin is better than gold. That's the surface argument. The real question is this: why would someone who has championed gold and silver for decades now say that if he had to choose one asset, just one, he would choose Bitcoin? When he says gold is, in theory, infinite, most people shrug. They think gold is scarce, and it is. But here's what most retail investors don't understand. When the price of gold rises, incentives change. Miners dig harder, exploration expands, supply responds. Gold has elasticity, it breathes. Bitcoin does not. Bitcoin is locked at 21 million. Not approximately, not around, exactly. The code doesn't care about inflation. It doesn't care about central banks. It doesn't care about political pressure. It doesn't care about war. It doesn't care about fear. That ceiling is mathematical, and that changes everything. Because every financial system in history has eventually been diluted. Every empire has printed its way into decay. Fiat currency is not money. It's a psychological agreement. And that agreement is breaking. Kiyosaki calls fiat fake money. That phrase sounds dramatic, but it's not. Fiat is backed by debt. It expands when governments need liquidity. It expands during crises. It expands during recessions. It expands during wars. It expands when banks wobble. And every time it expands, your purchasing power shrinks quietly in the background. You don't feel it all at once. That's the trick. It's slow. It's subtle. It's engineered to be tolerable. Inflation isn't just an economic phenomenon. It's behavioral conditioning. It trains you to accept less. And here's where it gets darker. When Kiyosaki says savers of fiat are the biggest losers, he's not attacking discipline. He's exposing a structural trap. Most people are taught to work hard, save dollars, trust the system. But the system is designed to erode what you save. The real game isn't about how much you earn. It's about what you store your energy in. Gold stores energy, silver stores energy, real estate stores energy, Bitcoin stores energy in a way no asset in history ever has. Digitally scarce, globally portable, mathematically capped. Now ask yourself this. Why would institutional money suddenly care about something that used to be dismissed as internet magic? Because they understand liquidity cycles. Every cycle has 3 phases: accumulation, markup, distribution. Retail investors arrive during markup, whales accumulate during boredom and fear. When the media says crypto is dead, that's when accumulation is happening quietly behind the curtain. And when price explodes and headlines scream all-time highs, that's distribution. The herd chases green candles. The elite buy red ones. Kiyosaki openly says he's glad he bought Bitcoin early. That's not bragging. That's signaling positioning. He understands that the fixed supply is not just a feature. It's a weapon against debasement. Now let's go deeper. When gold rises, supply can respond. When Bitcoin rises, supply cannot. So where does price pressure go? It compresses upward. It becomes explosive. That's why Bitcoin doesn't move gradually. It reprices violently. And violent repricing is where wealth transfers occur. Most people don't realize markets are not neutral. They are psychological arenas. Fear and greed are engineered. News cycles amplify volatility. Narratives are manufactured to create emotional reactions. When Bitcoin crashes 50%, headlines scream bubble. Retail panic sells. Whales increase bids. Liquidity transfers quietly from weak hands to strong hands. When Bitcoin rallies aggressively, influencers shout, "New era." Retail FOMO buys. Whales reduce exposure into strength. The human mind is the battlefield. Kiyosaki's projection of silver reaching $200 an ounce is another signal. He just bought 600 US silver eagles at $82 spot. That's not random. Silver historically lags gold, then outperforms in later cycle stages. It's more volatile, more explosive, and often more accessible to retail investors, which makes it a psychological magnet. But here's the twist. While people debate gold versus Bitcoin, the dollar continues to lose purchasing power, quietly, relentlessly. The silent reset isn't announced. It's gradual. Currency debasement is the most polite form of theft ever invented. You wake up. Groceries cost more. Housing costs more. Insurance costs more. Education costs more. Your salary maybe rises slightly. But your real purchasing power declines. That decline is the invisible tax. Kiyosaki urges people to stop working hard and saving fake government money. That sounds rebellious. But zoom out. Governments need inflation. Debt-based systems require expansion. Without growth, the system contracts painfully. So expansion continues. Bitcoin, by contrast, refuses to expand. Now imagine a world where institutional investors, pension funds, sovereign wealth funds, corporations allocate even a small percentage into a fixed supply asset. Supply doesn't adjust. Demand does. That imbalance is not linear, it's exponential. This is why some project $250,000 Bitcoin targets, not because of hype, because of arithmetic. Fixed supply plus expanding global liquidity equals upward repricing over time. But here's where retail gets trapped again. They think price only goes up, they ignore cycles, they ignore crashes. Kiyosaki himself has said he plans to buy more Bitcoin after crashes. That's elite thinking. Crashes are not threats, they are liquidity events. Smart money needs fear to accumulate. And while Bitcoin dominates headlines, XRP recently surged after regulatory developments signaled deeper institutional engagement. When a CEO joins a regulatory advisory committee, that's not noise, that's integration. It suggests digital assets are not being eliminated, they're being structured. Retail sees price spikes, institutions see policy alignment. That difference in perception is everything. XRP's breakout from consolidation into an upward trend, supported by expanding volatility and rising volume, reflects renewed conviction. Short-term moving averages curling upward, Bollinger Bands expanding. That's technical confirmation of narrative shifts. But don't mistake short-term momentum for long-term immunity. Crypto markets are liquidity-driven. They respond to macro conditions, dollar strength, interest rates, and risk appetite. When central banks tighten, risk assets contract. When liquidity returns, risk assets expand. Understanding that rhythm is the difference between gambling and strategy, Kiyosaki's worldview is simple but disruptive. Fiat is weakening. Scarce assets strengthen over time. Position early, endure volatility, accumulate during fear. Most people can't do that, not because they lack intelligence, because they lack psychological discipline. Fear feels urgent. Red candles feel catastrophic. Social media amplifies panic. Your brain seeks safety, not strategy. But wealth accumulation requires discomfort tolerance. Let's expose something uncomfortable. If Bitcoin truly is capped at 21 million and millions are already lost forever, and institutions are beginning to allocate and global liquidity inevitably expands over decades, then the real question isn't whether Bitcoin goes higher. The real question is how many cycles of volatility will shake you out before it does, because that's the design. Markets test conviction. When Kiyosaki says he would choose Bitcoin over gold if forced, he's not abandoning gold. He still owns it. He still mines it. He still believes in silver's upside. But he's acknowledging something fundamental. Digital scarcity in a digitally connected world may be more powerful than physical scarcity. Gold requires storage, transportation, verification. Bitcoin requires a private key. Gold can be confiscated physically. Bitcoin requires access credentials. Gold's supply can expand gradually. Bitcoin's cannot. Now think psychologically. The older generation trusts gold because it's tangible. The younger generation trusts code because it's programmable. The transition between those trust systems is generational wealth transfer. And during transitions, volatility intensifies. Governments won't publicly endorse losing monetary control. Media narratives will oscillate between celebration and fear. Regulation will tighten, then loosen. Crashes will occur, recoveries will shock. All while fixed supply remains unchanged. This is why the conversation isn't about assets. It's about positioning before repricing. Silent wealth transfers happen when systems shift. When currencies weaken against hard assets. When debt burdens inflate away. When savers holding cash realize too late that nominal stability hides real erosion. If you're holding only fiat during a currency reset, you don't see the transfer. You feel it slowly. If you're holding scarce assets during expansion, you feel acceleration. But let's be brutally honest. Bitcoin is volatile. It can drop 70% in a cycle. It can test your conviction. It can make you question everything. Gold is steadier, silver is explosive, but smaller, real estate is leveraged and illiquid, Ethereum adds programmability, each asset has risk profiles, Kiyosaki advocates diversification, but forced into one, he chooses Bitcoin. That tells you where he sees asymmetric upside. Asymmetric means limited downside relative to potential upside over long horizons. Now ask yourself something uncomfortable. If the dollar continues losing purchasing power, if debt continues expanding, if global instability persists, if institutions allocate even modestly to digital scarcity, what happens to price over 10, 20, 30 years? And more importantly, where will you be positioned? Because here's the part no one wants to say. The biggest barrier to wealth isn't lack of information. It's emotional reaction to information. People know inflation exists. They know debt is rising. They know money printing happens. But they delay action because change feels risky. Yet staying in a debasing system is also risk. That's the paradox. The system teaches safety through conformity. But conformity often means holding the most diluted asset in the room. Kiyosaki's message is confrontational because it attacks that comfort. Stop saving fake money. Save real assets. That doesn't mean recklessness. It means understanding monetary history. It means recognizing that fiat cycles eventually reset. It means seeing that scarcity, whether digital or physical, protects purchasing power over time. Now imagine the next crash. Headlines declare crypto finished. Influencers disappear. Prices plummet. Social feeds turn silent. That's when elite positioning intensifies. Liquidity seeks distressed assets. When fear peaks, opportunity hides. Will you recognize it or will you react? That's the psychological war. Because markets don't just measure value, they measure conviction. The final twist is this. Even if Bitcoin reaches $250,000 or higher, even if silver hits $200, even if XRP integrates deeper into financial systems, the game doesn't end. Cycles continue. Volatility returns. New narratives emerge. The elite don't marry narratives. They manage exposure. They understand that real power isn't in predicting every move. It's in aligning with structural advantages, scarcity, decentralization, and long-term liquidity expansion. And that's what Kiyosaki is pointing toward. Not hype, structure, not emotion, mathematics, not headlines, incentives. When you strip away noise, the thesis is simple. Fiat expands, scarce assets don't. Over time, expansion versus constraint creates repricing. The only variable is time and your ability to endure volatility. So here's the warning. If you continue working hard and storing your life energy in a currency that loses purchasing power, you may never feel poor, but you will slowly lose ground. If you move blindly into volatile assets without understanding cycles, you may experience euphoria and devastation. The path requires knowledge and discipline, and that's rare. Most people want comfort, few want truth, but truth changes positioning, and positioning changes outcomes. One day, years from now, when the repricing is obvious and headlines call it inevitable, most people will say they saw it coming. They didn't. They heard it. They dismissed it. They waited. Don't confuse awareness with action. Robert Kiyosaki choosing Bitcoin over gold if forced isn't a casual comment. It's a declaration about where he sees structural strength in a world of expanding debt and weakening currency. You don't have to agree, you don't have to follow, but you do have to understand the implications. Because whether you participate or not, the cycle will move. Liquidity will expand and contract. Fear will rise and fall. Scarcity will remain constant. And wealth will transfer quietly from those who react emotionally to those who position strategically. The question is not whether Bitcoin replaces gold. The question is whether you recognize the battlefield before the next shift begins. So tell me this. If you were forced to choose only one asset for the next 20 years, Bitcoin, gold, silver, real estate, or fiat cash, what would you choose and why? Drop your answer in the comments. I want to see how you're thinking. Send this to someone who needs to hear it before the next cycle turns. And if you're serious about understanding the hidden mechanics of money, subscribe now and turn on notifications, because the next shift won't announce itself.